Well, after a nice week off, I, like new American Idol judge Steven Tyler, am back in the saddle again, here with Howard Lindzen to start talking about some stocks. IBM, Big Blue, it's a boring, staid company, but it's at an all-time high, just like Apple and Netflix and other hot momentum tech stocks. What's up with that?
Here's the difference about IBM. Service, think of IBM as lawyers on top of hardware. So not only are they dishing off to China the low margin hardware, they're keeping the high-end hardware, handling storage, and then they send out an army of lawyers trained as salesmen to, provide services. So they really are the biggest software as a service company, and that's why they're getting treated as a growth stock right now.
Looking at another tech stock that may not be treated as much like a growth stock anymore, Intel. Their numbers that came out after the bell on Tuesday, pretty decent, but you have to factor in the fact that they warned a few weeks ago as well, so they just beat their lowered forecasts. Are people on the stream excited about Intel or no?
If they are, they don't know what they're talking about. I'm kidding, but the Intel story is we trust Intel. Intel's a government. They're a government of technology and chips. So I trust Intel more than I trust the Fed. So all I would look to Intel for is a complete miss, some kind of wacky gain. And what Intel's saying is business is good. So really, the institutional money flows to growth. So even though Intel's saying we bless our numbers, that's the bait and switch. There's no reason to watch Intel after that news comes out. Immediately, the institutions are out grabbing the real growth stocks. So again, Intel okay means high beta stocks better than okay.
Right. Good point there. Moving on to another sector that's been inexplicably hot, retail, particularly children's retail. Gymboree, the buyout by Bain, you're seeing now this big rally for Children's Place as well. Carter's got a nice bump. What are people talking about on the stream in terms of M&A and retail?
I got a little chart here, even though I won't see. Look, wow, we're getting interactive. So the demographic trend is this. Never been married going like this, been married going like this. Being married, all kidding aside, is expensive. Never being married means having more money for luxury goods, and that's why the luxury brands don't have to get bought out by private equity firms. Their stocks are going this way. Maybe on the camera it looks the wrong way, but I'll get used to that. On the children's side, since fewer people are getting married demographically, stocks have struggled. And, the private equity firms are seeing value. I generally avoid places where I'm making gambles that someone else thinks something's cheap. As a small investor, I prefer to go where the herd is feeding and where the trend is my friend. So retail's been strong, but it's really the high-end retailers because of this demographic shift to singles.
JP Morgan Chase came out Wednesday morning. Their earnings were better than expected. What do you think about banks right now, bull or bear?
Well, I don't own them, so I got to say I'm a bear. I think there's going to be massive distribution as financial earnings become less important to the S&P. I think kids will be less interested in taking banking jobs. I think it's just, a natural cycle of this thing. There's better opportunities elsewhere. I don't trust a thing these people say, and there's no reason to trust them.